Hello guys, hello everyone, welcome to the step 2 of your trading journey. And in this video we will focus again on structure and specifically on very important concepts, and we will start to formulate some rules we will use in our future trading and in future strategy. So in the previous video we discussed a very basic understanding of structure, and we said that if the market creates some kind of bearish or bullish impulse, or bearish or bullish price action or price expansion, we can expect that it will hold and continue and will create new lower lows and lower highs, or higher highs and lower highs, higher lows. So for instance, in this case we had a bearish push, and now we expect a new lower high somewhere inside this price expansion, and then continuation to the downside. Then again, when we have this range, we expect the price to hold somewhere here, so somewhere inside of this price expansion, and then continue lower. And what we also discussed is that we can have different views and different markups of the structure. So we can say that this all is a huge move, huge move to the downside. Then we can say that inside this move there were some moves like this, so bigger moves, and then also inside these moves we can say that there were moves like this, and then we can go even lower, and you see, if we really look into the structure, we will see that the price moves like this: down, up, down, up, down, up, down, up, down, up, down. You see, so like candlestick structure, like really fractal level of structure. So that's a quick recap of the thing we did in the previous video. But now, how can we make it more practical and more suitable for actual trading? Because we need some rules that we can execute like an edge. And structure is the basis of the strategy of the trading system. So it's really important to understand it correctly right away. So first thing we will discuss today is the pullback rule. So what does it mean? So for instance, if we are looking at any given time frame, how can we say that we have how can we differentiate the ranges or price expansions? So for instance, a person might say that his or her impulse that he wants to mark up is this one, so this huge move. But then a different person can say, but no, wait, we have this move and then this big pullback and then one more move. So the question is this one huge move, or is it two moves like this, or is it like one down move, pullback, down move, pullback, down move, and pullback? So what is this? So for this we will have a pullback rule, and on any given time frame, when we see, let's start from here, when we see a break of structure, we say, okay, our impulse is going like this, and now we need a significant change in price action in other direction, so we can call it a pullback. And calling something a pullback, we will differentiate one impulse from the other impulse. And when I say impulse, just so we don't confuse each other, so impulse will mean the same as price expansion and the same as range. So when I say impulse or price expansion or range, this is all the same thing. It's all the same thing, okay? So we have this range, and now when the candle will close above the previous candle, we can say that our pullback started, okay? So let's look closely to this price action. So what we have here? We have a candle. So first of all, what is a breakout structure? A breakout structure is body close below or above previous high or low. Okay, and now we will come back to what is a low or a high, but in this case, this is a breakout structure. And now to say that we have a pullback, we need the next candle to close above the previous one. So did this candle close above this one? No. And this one, did it close above the previous one? No, 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 no. And only this candle, this one, closed above the previous candle. So that's why we say, okay, this is the place where we had a pullback, a significant change in price action. And so we can differentiate now, and we say that the pullback happened here. Now let's retrace price to the lowest point before the pullback, and that would be our low. So our low is not this, but this one, the lowest point that happened before the pullback, okay? And based on this, we now have this specific range. Okay, so you see what I'm doing? I'm marking up the structure based on a very simple rule, but it will allow us to have a really objective, really clear structure. Okay, and so now to say this is your low and where is the high of this range? To answer this question, we need to say we have a new low. Where did this low came from? And now we need to retrace the price back and see where did the pullback happen from the other side. So we have a pullback here, you see, with this candle, and now we have a pullback here. So the first occasion where a candle closed above the previous one was this one, you see. So this candle closed above previous one, so this was a pullback from a previous range, and now we say that this is our high. And in such a way we have our price expansion, our range. So this is a breakout structure, this is price expansion, the range, this is a new low, this is a pullback, and this is a high. Okay, now let's do the same with the next price action. So if this is a low, remember breakout structure is a body close above or below the level. So this candle closed below the low, so this is a new low. Why? Because pullback started with this candle, and we trace the price back, and this is the lowest point before the pullback. Now we ask ourselves, where did this low come from? And it came from this high. Why this high and not this high, for instance? Why? Can you answer this question? Because the first time before the low was created, this candle is the first time when the pullback happened. Yeah, so we have a pullback here and we have a pullback here. So this is price expansion. Now we have this level, and as you see, we never had a new bearish range here, new bearish price expansion. Instead, we have a candle that closed above this line, this high, and now we have a bullish range. But where did the pullback happen? Did it happen on this candle? Can you answer this question? Did it happen on this candle? And the answer is no, because though the wick came lower than the previous one, the body didn't close. didn't close below the previous candle. So for us, this is not a significant price action, and that's why we continue to trace the price and we see where was the first time where pullback happened. And for this price action, this candle closed below the previous candle. So this is a pullback, and now we trace the price back and search for the highest point before the pullback. And this is the high. You see, this is the highest point. So this is the high. And now we need to ask ourselves, where did this high come from? So this is the high. We trace the price back and see where was the first pullback. So in this case, we need a candle that closed closed above the previous one. Yeah, below the previous one. So in this case, it was this candle. Okay, it was this candle, this one. So so that's why this is price expansion. This is the high, this is the low. And that's it. I think these three examples are okay for now. And you know how to see a break of structure. Now you know to see how. Now you know how to mark up a low and how to mark up a high. Okay. Now, the next very important rule is reading the structure from left to right. This is crucially important. Okay, so please pay attention now, and if you need, you can rewatch it later. But basically what it means that when you are looking at the chart, the really big mistake that people make in the beginning is that they are starting to analyze the chart from right to left. And what it does, it makes them really confused about their break of structures, and they don't really understand inside what range they are in now. So what I mean simply is this. So for instance, if I'm telling someone, can you tell me where were your break of structures on this chart? Usually people will start from right to left and they say, okay, so this was some kind of break of structure, so this one. And also this one was a break of structure. Yeah, but at the same time, this was a break of structure to the upside and then to the downside. And for some people, even this, so we have this body close, even this will be a break of structure, yeah? But the market didn't develop from right to left. It really developed from left to right. So we need to read it like a book, you know? So when you have a book, you are starting to read. Most people from most cultures will read from left to right. And this is the same for the market. So when you have any kind of chart, just zoom out a bit and start to mark up your structure. So for instance, we see that this was some kind of a low. It happened like really a long time ago. So we can say that this was a low, and this was a range that broke it. Okay, this was a range that broke it. So it created a new low. So let me take my line instrument. So we had a low and we have a break of structure where? On this candle or on this candle? On this candle, because this candle closed for the first time with its body, and now this is a new low. Where did it come from? Somewhere from here, yeah, actually even from here, because this was a gap. So we can say this was our protected high. And by the way, if we are talking about bearish ranges, our highs will be protected highs. Why? Because as I was telling in the first video, and I will come back to it later, when you have a bearish structure, you expect the smart money, the institutions, to hold the ranges, because they don't need to go any higher than this. They just need to go, come back, mitigate some orders, yeah, at break even, and continue the price. So that's why we call it protected highs, but a bit more on this in the next videos. Now we actually don't need. don't need it. So this was a protected high, and this was a new break of structure, this one, this candle. And now we trace it, and we already discussed this. We had this one. Okay, so this is a new low, this will be a new high, and this will be a new low. And as you see, this high became a break of structure from this. And I will just take my brush so it will be faster. So we had this range, and now you see this is not a break of structure, this level. Why? Because it's happening inside this bigger price expansion to the left. And so when we see something like this, we say that we are inside bullish true range or bullish true expansion or objective expansion or outside structure or institutional structure. So I will write down these words once again. So when we have so ranges that are like real, they are a true range, then institutional, then outside structure, yeah. And then what happens, why it's true, why it's institutional or outside, yeah, because it defines the bias. So when we are inside here, for instance, at this point, we are still bullish, though we had some inside break of structure, yeah. So this is outside structure, and it defines the overall condition of the market, yeah. So for this time it's bullish, and this break does not do anything in terms of bullishness or bearishness, yeah. At this time we need to understand it like this. And so the first real break of structure and real bearish shift happens with this candle. And now we have a new low here, a new low, and we need to ask, where did this low come from? And it came not from here, as you see, because no pullback happened, but from here, because the first time candle went and closed below, yeah. So we had a range and a range. Yeah. And what's interesting, we had this huge price expansion or price range or true range institutional structure, yeah, from here to here. And now you see how many inside structure market created after this. So at this time we will not count this one candle as a closure, just for simplicity. But we have an outside structure, and we are still bearish, at least before we have this break of structure, or we have a break of structure to this side, to the bearish side, and then re-break back bullish. Okay, so this is inside structure and outside structure. It's important to understand it and to differentiate it, because if you will not do it, you will be like really confused about where you are in the market. Okay, and the third question we need to discuss in this video is the concept about which says to us that market is fractal. So what it means is, again, it's really simple concept, is that structure, you see, is basically the same principle applies to the structure on different time frames. So you see, we also have outside structure on a monthly, we have outside structure on weekly. So on monthly this is one move, on weekly we have already some new ranges, yeah. So we have new ranges on weekly, and on daily we will have even more ranges on 4 hours, but basically we have the same patterns on every time frame. And why it happens this way, I will tell you later. But now, how can we use this concept for actual trading? Again, in this video, of course, we are not discussing the actual strategy, but we need to make these rules a bit more practical. So what I mean by this is, imagine if you're watching the market and you see that your weekly is bearish. Then you go to the daily and you see that your daily is bearish. And you go to 4 hours and you see that your 4 hours is bearish. And then maybe you go even to 1 hour, and now as you see, if you will stop the video, you will see that now 1 hour is bullish. So what I mean by this is, if you realize and you can mark up the structure correctly, you can find places where you will be bearish on every time frame, from daily, for instance, up to 1 minute. And then you can use this confluence to place your trades. Of course, we will apply more additional rules for this, but overall, if you have a lot of confluence, then you can consider this a high quality, high probability trade. So let's look closely. So for instance, we know that we are let's go back in time on this one. Yeah, so as you see, everything is bearish on weekly, and recent ranges were, so this was a break of structure, this was a protected high because this was a low, it came from here, and now we have bearish daily, bearish weekly. As you see on daily, we also are now inside the bearish structure. Why? Because if we go from left to right, we had, so let's assume that this was a low, we had break of structure, we have a low that came from here, we have a high, now we have a low, so this is the same example we discussed before, and now we are inside this bearish range. Okay, so let's go to 4 hours. As you see, on 4 hours we are also bearish. Yeah, now, and of course we are bearish on 1 hour and so on. So this is a situation. So let me play it a bit. Where is my player? Yeah, here it is. So yeah, let's go to here, for instance. So now we are bearish on 4 hours. Now we go to 1 hour, and as you see, on 1 hour we are also bearish. So we had a break of structure, this price expansion, this one, and now price, as you see, this kind of price action is bullish on lower time frames. Yeah, let's go for instance on 5 minutes. Can we go? Yeah, so you see, remember, we are bearish on weekly, on daily, on 4 hours, on 1 hour, but now we started to shift on lower time frames. So actually at this point, as you can see, we had this huge push, and now we just shifted bullish with this candle. Okay, so at this point we have no like total confluence, but later, if we trace the price, we had this range, and now we just shifted bearish even on 5 minutes. So on this point, because we shifted bearish on 5 minutes, now we have bearishness on daily, on 4 hours, on 1 hour, and on 5 minutes. So we have huge confluence, huge bearish order flow, and realizing it, we can place a high probability trade to the bullish side using supply and demand zones, which we will discuss later. Okay. And basically that's it for today, and this is your task for after this video. First of all, you take any kind of chart and you mark up break of structures, protected highs, and new lows or new highs created. So let's take a different chart. for instance USD GPY. So you take this chart and you go, as you know, from left to right, yeah, and you can use just a trend line or anything, or even just a line, a brush. For now, you can even use a brush for simplicity. You don't need to go all the way to the left because it does not make sense. It's okay to go just zoom out a bit and start from here and find your price expansions and pullbacks. So the first task, you go from the left and you say, okay, my first range, my first price expansion was this one. This is my outside structure. Now this is my inside structure. Before this candle happened, and we had a bullish break of structure and we had a new high. So where did this high come from? It came from this low, you see, from this low. Why? Because this low had this pullback, so a candle that closed above the previous one. It was candle that closed below the previous one, this candle. So this high came from here, and now, as you see, we have a really nice price expansion, bullish leg, yeah, bullish range, and this is inside structure. So this is inside structure. Now this candle created a new range. It created a break of structure exactly at this point because it closed above the range. And now we need to say, where is our high? Is this our high? No, because we didn't have a pullback. First pullback happened here with a candle that closed below the previous one, and this is the high. So we trace the price back. This is the high, and now we need to find where did it come from. It came from here. Okay, so this is a low, and you go like this on any kind of chart, and you say, okay, so this is a pullback at the moment, and this is break of structure. Where is my high? This is a pullback. So this is not a pullback. A pullback happens on this candle because it closed below the previous one. This is the high. It came from here. So we have a bullish leg, again high. So I will be a bit faster now. Low, inside structure. So at this point we will not count it as a break of structure, just a new leg and a new leg. And you continue doing it like this. So this is the first task. You need to mark up bullish or bearish legs or price expansion or ranges. You need to show me that you understand that you have outside structure and now inside structure before the new break, and say that where is your protected low, where is your new high. Okay, then and then next task for this video. So we have break of structures, inside structure, outside structure. Yeah, and basically that's it. It includes all the concepts we discussed now. So you just need to be able to mark up the chart on any given time frame. Okay. Yeah, send me your questions and I will be waiting for your homework.